Hey everyone, Steve Penny here. Today's Sunday, August 2nd, 2026, with your weekend solar charts report and video. We're going to do something a little bit different this weekend since I'm traveling in a hotel again this weekend and next weekend. So what I'm going to do is just share my screen and go through what I think are the most actionable takeaways and key insights for the coming week ahead. So we'll go ahead and dive right in. But first, let me give the obligatory disclaimer. I'm not a financial advisor. Always do your own due diligence. Never take anything I or anyone on this website says as personal advice. I have to say that, really do mean it. All right, so we'll start off right here, right off the bat, with what I think are the most actionable key takeaways from this video for this coming week. And number one is uranium. I just want to reemphasize that uranium remains my highest conviction sector for the remainder of 2026. Now, over the long term, over the next handful of years, I think it's a coin toss between uranium, silver, and platinum. But for the next few quarters, for me, uranium is the highest conviction setup. And a couple of reasons for that are: number one, uranium is cheap when pricing gold. When I look at the gold to uranium ratio, uranium is breaking out in multiple time frames after a period of massive underperformance. Uranium had underperformed gold for 15 consecutive months. That was a record, at least as far as the data I can see. And now it's beginning to turn. So that's one reason. Number two, uranium has yet to make a new all-time high above its 2007 $148 peak. Silver's made a new all-time high. Gold has made a new all-time high. Uranium is still way below its previous all-time high. And I think it's ultimately going to surpass that all-time high, just like silver and gold did. So on a ratio basis, uranium is cheap. And also, when I look at the Sprott Physical Uranium Trust, it is trading at a pretty excessive discount to its net asset value. It's pretty rare to see the discount to net asset value greater than 10%. Well, right now we're over 12%. And this is at an area that's consistent with pretty durable lows in the sector. Doesn't mean you can't go a little bit lower. We'll take a look at the historical chart of that discount to NAV. But that's a reason to begin accumulating. At least it is for me. When I look at the short interest in stocks like UEC and Oklo, it's pretty elevated, especially Oklo, up around 19% of the shares are sold short right now, with UEC around 12%. Cameco had somewhat disappointing earnings, at least that's how the market perceived it, which I think creates an opportunity for that particular stock and the sector as a whole. Moving on to actionable takeaway number two, when it comes to precious metals, to me, Royal Gold is the best value proposition in the precious metal sector, with Core Mining CDE being a close second for those with a high risk tolerance. Royal Gold is kind of a top tier blue chip royalty and streaming company with a little bit maybe less upside potential, but less downside risk. On a risk reward basis, I like Royal Gold a lot. It's by far my favorite stock right now in the sector. With Core Mining, being a mining stock, mining stocks are inherently risky. Where Royal Gold is a royalty and streaming company, which reduces some of that risk. But Core Mining, I think, is a close second for those with high risk tolerance. I like both right here. And then number three, actionable takeaway: 10-year, the interest rates are rising and they're at near 20-year highs, especially on the longer duration treasuries like the 30-year. So what I'm watching is the 5% level on the 10-year treasury note. The 5% level. That's where we got to right about there in the tariff tantrum of 2025 back in April. And that's a level to watch closely, because with nearing a $40 trillion national debt, what is a 5% interest on $40 trillion of national debt? Well, 5% of $40 trillion is, I'm no math genius, but that's about $2 trillion. That is a massive interest expense, considering the government collects somewhere around $5 trillion in total gross tax receipts, federal tax receipts. So we would be approaching a level where almost 40% of federal tax receipts go towards just servicing interest on the debt. And especially if we break out above that 5% level and move up towards the 6s and 7s, you can see how this can spiral out of control pretty quickly. So let's watch that very closely. Any rise in interest rates is likely to have a negative effect on our focus sectors and general equities at large, just risk assets across the board. If you want to talk about the potential for a deflationary impulse, that could coincide with a rise in interest rates. So we'll be watching that very closely. So those are the key takeaways. Now, just a couple of housekeeping notes. You'll see on this events tab on silvercharters.com, we've got two events coming up. The first one is this Wednesday, where I'm going to just walk you through my personal financial freedom framework. It's how I structure my own personal assets and investing. And I think the structure is super important. Rather than predictions and which sector is going to go up, having a structure that is resilient and can prosper in a variety of different outcomes is important. I'm not saying that I'm not recommending, of course, that you should do exactly what I'm doing, but hopefully it spurs some thought and helps you to maybe consider some small tweaks that you can make to your own personal financial plan and improve along the way. So you can come to this events tab, click on that, and hit register RSVP. If you can't make it live, we'll send out the replay shortly after. And then we've got this health and wealth retreat with Chris and Brett Botcher. We're going to do it in Franklin, Tennessee on October 23rd. It's a weekend event, and you can click here, and I'll just go ahead and open it up. And if you click right here, you can RSVP. It's only going to be 30 people, and we're going to spend Friday, Saturday, and Sunday together. We're going to do some presentations. We're going to enjoy a couple meals together. We're going to go hiking, and there's only 30 seats available. This isn't some kind of thing where we're trying to make a bunch of money or anything like that. But these kind of events are, especially with only 30 people, you consider meals and renting out a place. It adds up. So it's the cost is $1,000. So like I said, we're not trying to make a bunch of money on this. The idea is to cover the costs and go have a good time and connect with some like-minded people. So there's 30 seats available. Still a few spots left. You can click here and register. Chris and Brett are handling all the admin on that. They asked me if I would be a part of this event with them, and I love these guys. They're doing. I feel like the heart behind what they're doing with Brother to Brother when it comes to health and wellness and health and fitness coaching is very similar to Silver Chartist. Like our culture and the kind of people that we have in our respective communities. I think there's a lot of overlap there. So when they asked me to partner with them on this event, the answer was yes before I even knew what they were asking. So these guys asked me to partner with them. The answer is like always yes. So I think it'll be a lot of fun. We'd love to see a couple of you guys out there, and that's it for that. Here's our Silver Chartist portfolio. Some people have asked, where do you find the portfolio? It's right here. And you can see here, I'm not going to go through these too much, but at the top of my list that I want to accumulate is Royal Gold. I want to get to 100 shares so that I have the option to sell options. You need 100 shares represents one options contract. And that's just nice to have that tool in your toolbox. When you get extreme overbought against resistance, well, you can sell call options. Or when you get extreme oversold against support, you can sell puts. Love that as an income strategy. Just doing that several times a month, we've been making several $1,000s. I mean, you need a decent account size to make $5,000 or $6,000 a month. But for someone with, say, $25,000, I think it's totally reasonable to make 2% per month by selling options. And that's what we do in the Options Amplifier group. That's our realistic goal, is 2% per month. So on a $25,000 account, that's $500 a month with a relatively lower risk strategy. High consistent, high accuracy strategy is the word I was looking for. We're batting around 90% in that options group. So you can see here all our open positions. And then for Options Amplifier people, this may be available to everyone just to see the portfolio. We just added this tab, Options Amplifier portfolio. You can click that, see a video of it's like 4 or 5 minutes just explaining the open positions, and that's there for all the Options Amplifier people. So far, year to date, we've collected $32,484 in options premium with a projected annualized return of 53.8%. That's well above our target of 25%. I don't want to set the expectation that we're going to do that consistent, over the long term, but we do have enough of a sample size where the data is pretty accurate. So we've had 122 wins and out of 136 total trades. So we made 136 trades in just about 6 months with an 89.7% accuracy rate. I'll take that all day long. Let's see here. COTs, we'll just briefly cover these before I move on to the charts. You can see here's the gold commitment traders report. The commercial net short position has remained just steady going back to January, which is interesting. And at the risk of being overly repetitive, I think the steady commercial net short position combined with a decline in open interest, and this is true for silver and platinum as well, especially platinum, signals that the price discovery mechanism for these precious metals is shifting from the west to the east, where it's more of a physically supply demand, where price is set based on physical supply demand, not the supply demand of paper contracts that can be created at will by these bullion banks. Here's the silver COT. Looks very similar. See that commercial net short position is represented by these blue bars, just steady since January, but there's a decline in open interest, and also same thing in platinum. Look at the decline in that open interest to these green bars down here at the bottom. The commercial net short position has been declining in platinum, making platinum pretty interesting here. And anything near $1,500 platinum, I think could be a really good opportunity for those who maybe didn't have the opportunity to accumulate down when it was kind of boring, around 1,000 or even less than 1,000. Interesting here, palladium. I do favor platinum over palladium based on the ratio and supply and fundamentals, but it's interesting to note that the commercial banks are actually net long palladium. So it's kind of different. It's an outlier from the other metals here, platinum, silver, and gold. All right, let's switch gears and talk about some charts, and then I'll get you out here for the weekend. Here's that 10-year chart, and the chart for the 10-year Treasury note that I was talking about, and you can see the significance of this $5 level here back in October of 2023. We got as high as 5%. 5 was the high watermark right here over the last few years. A break above that 5% level could signal trouble for many risk assets and trigger the government to, and central planners, i.e. Federal Reserve chairmen around the Federal Reserve and other central banks around the world to take some pretty draconian or dramatic steps. Who knows what they're going to do, but I think they're going to fight tooth and nail from allowing interest rates to get above 5%. Some form of yield curve control could be coming. Another scheme that involves currency debasement and debt monetization. I think that's all coming, and it'll come faster if we get above this 5% yield. Let me just open this up here real quick. I like to look at this at least once or twice a month. And I circled some key numbers on this USDebtClock.org. There's a lot of data in here, but to me, there's 3 numbers right here that are most significant. I circled them in black. U.S. national debt, 39.7 trillion, let's just call it 40 trillion. U.S. federal tax revenue. So we're on track to collect $5.5 trillion in federal tax revenue. Well, now when you come down here to the largest government expenses, the big 4, some people call them Medicare, Medicaid, Social Security, Defense, /war, war is a better description, and then interest on the debt. So just these 4 things, note that you sum those up, you don't need a calculator, you just round to the nearest trillion. 2 trillion here, 1.7 trillion here, that's 3.7, let's call that a trillion, 4.7, let's call that 1.2 trillion. Now we're at $5.9 trillion on the top 4 things. That's how much the government spent, just on 4 things, let alone all the other things the government spends money on. And how much have they collected? 5.5. So just the top 4 expenses exceed federal tax revenue. So what does that mean? Unsustainable. And then we look at interest rates rising up near 5%. Like I said, apply 5% interest rate. Now that's just for back of the napkin math. Of course, not all of that debt is financed at the 10-year rate. There's a spectrum of interest rates, but I don't know what the effective tax rate or interest rate is what I meant to say on this is, but just applying a 5% general back of the napkin math, 5% on 40 trillion is $2 trillion, $2 trillion of interest expenses. And you can see down here, we're just over halfway through the year. And look, we're already over $1 trillion of interest expense when they've only collected $5 trillion. So what's that? 20%, about 20% of every dollar of federal tax revenue is going just towards interest on the debt. This does not end well. I call this unsustainable. And this is why right here, these 3 numbers are the reason that I invest in silver and gold and precious metals, because this situation is repeated throughout history over and over and over again. Michael Maloney calls it the 7 stages of empire. Governments expand beyond what the tax base can support. They get into military conflicts. The money just isn't there to pay it. And then what do? They debase the currency over and over and over and over and over again throughout all of history. And what is the prime beneficiary? Silver and gold. Every single time. 100% of the time. Could this time be different? Anything is possible, but I'm not betting on this being the first time that silver and gold do not do a full accounting for the expansion of debt-based fiat currency. So the wild volatility, ups and downs, and trading and resistance and support, yeah, I use that to make cash flow. But my physical metal, I'm holding on to that stuff until somehow this resolves with either a new financial system or a complete hyperinflation, and then our physical metal will bridge the gap from this system to the next. So just want to add that context. All right, let's take a look at a couple of ratio charts. I like to look at ratios. I look at them every single day. I don't want to bore you with them over and over again, but once a month or so, we should take a look at some of these key ratio charts and just see where we're at. So the gold to silver ratio, 43:1 is like a key number, I think, to keep in mind for the long term, because you can see the significance of this 43:1 level. Going back to the 1970s, this ratio has spent very little time below 43:1. So what does that mean actually? Well, if you get below 43:1, or at least near it even, well, that'd be a good time to swap some silver for gold, because when you get these reversals like we just had, where do we get down to in January? 43:1. You could have swapped 43 ounces of silver for 1 ounce of gold. Well, right now it's back to 71:1, so kind of neutral territory here. But when we're down to this 43:1 level, key takeaway, that's a spot to consider swapping some silver for gold, which is obviously less volatile. Another one that I really like to track is how many ounces of gold or silver does it take to purchase the median U.S. home price here in the United States? And I'm no expert in foreign real estate markets, but I bet it looks pretty similar to this chart. If you plotted the median home price in gold in markets around the world, here in the U.S., this 73:1. We got down there in 1980. Where did we get in January? Precisely 73:1. Precisely 73:1. Now some people may look at that and see we got to the previous all-time high or low, depending on how you look at it, and that's the end of this gold bull market. I don't think so. I think we're going lower than we were back in the 70s. Now this was a great short-term opportunity, and we did trade some silver PSLV for real estate investment trust, which we'll see that ratio here in a minute. But anyway, we're back to 100:1. We're bouncing off 73:1. So that 73:1 is a key number, especially if you're someone who is maybe looking to buy a home like I am, or looking to invest in rental properties. I'm not necessarily looking to do that. I prefer real estate investment trusts because I don't have to deal with tenants, toilets, and all this kind of stuff. I can collect really nice dividends from real estate investment trusts. I can collect options premium by selling calls and selling puts around core positions, and I think I can yield probably more income by using our options wheel strategy along with the dividends than I can having to deal with some tenants. But anyway, regardless, that's a ratio I track. I didn't mean to go on that little bit of a tangent. Here's the average home price, median home price, price in silver. Got down to 3,376 ounces. That's pretty crazy. You could swap 3,300 ounces of silver for the median home price back in January. Now we're back above 7,000, so it's doubled. Interesting ratio to track. Another one, I really like this one because I love cash flow in the form of blue chip dividend stocks, and SCHD is my favorite way to just collect, kind of sleep well at night, passive income. Every quarter, you get sent a really nice check. I reinvest those dividends, and then my income grows over time, and it compounds. Some people look and say, oh, it only yields 3.5%, 3.8%. Yeah, but it compounds, and that dividend, it grows over time, and it grows at a pace that is greater than inflation. It has historically for the last 14 years. So yeah, you can look at it as 4%, but the compounding effect, by the time I go to actually draw those dividends instead of reinvesting them, what's called yield on cost will probably be well into the 10, 11, 12 or more higher percent. So yield on cost is what I care about. Anyway, back in January, we got to this 1.31 ratio. Now we're all the way down here to 0.5. So this has fallen by more than half as SCHD has continued to go up and to the right and silver's gone down. So we swapped at a good time here. I look forward to swapping more paper silver PSLV for SCHD to gain cash flow when we get back to this previous all-time high around 2 to 1. And one more ratio chart here is PSLV to SCHH. This is a popular real estate investment trust ETF. Another one is VNQ. And we kind of got a little bit lucky here. Well, I'm not trying to say luck because I was looking for this previous all-time high. So we hit that and I dispassionately executed my plan and swapped PSLV for SCHH right at that peak. It's now since come down a lot. If we get back up there, I might swap a little bit more. One more ratio. Uranium to gold came off of this period where gold had outperformed uranium by 15 consecutive months. I don't see a single time on this chart where that's happened before, and now it looks like we're beginning to turn the corner, with uranium expected to outperform gold by a fairly wide margin. All right, let's take a look at some charts for gold, silver, uranium, and energy, and then we'll get out of here with an emphasis on what I think are the actionable takeaways. Gold, and same thing with silver. I'm calling this baby step 1. This is the first step of a technical reversal. So the first step is we broke out from this downtrend line, this steep downtrend line. Just like uptrend channels that were unsustainably steep at an upward trajectory, well, in the same way, this is kind of unsustainably down on that trajectory. So we got a breakout. I mean, it's a small one. It's only 2 days. We broke out, back tested it. Nonetheless, it's a breakout. It's the first sign of a technical reversal. But we've got a few more steps to go. So that's baby step 1. Baby step 2 is getting above this blue 50-day moving average, which is coming down every day and then getting above the yellow 200-day moving average. That's the big one. We don't want to be below a declining 200-day moving average, as those institutional trading algorithms tend to go into a sell the rally mode when prices below declining 200-day moving average. It's still sloping upwards, but just ever so slightly. So step 1, check. Step 2, blue 50-day. Step 3, yellow 200-day. And then I would say step 4, the big one. You can see this. I should label this here, but this swing high was $4,917, so $4,900. Let's just call it. Getting above $4,900, and right above there is psychological resistance at $5,000. So let's call the $4,900 to $5,000 area will be the next big test. I don't expect that anytime soon. I wouldn't be surprised to see a rally up towards $5,000, but getting up towards this $5,400, $5,600 level, it's not my highest probability outcome for the remainder of 2026. It's coming. Just I think it's going to be a little bit more time than many people think. Gold miners has still not cleared this downtrend line. So baby step 1 not yet accomplished in gold miners. Much like gold, it's got to break the downtrend line, then the 50, then the 200, then make a higher high above 102. Then you got the previous all-time high at 117. So I like accumulating gold miners on weakness here. I do want to get 100 shares of GDX, but I also want to get to 100 shares of Wheaton Precious and Royal Gold. So since I'm closer to that objective in Royal Gold and Wheaton Precious, those are the ones at the top of my accumulation list. Speaking of Royal Gold, here's my if-then statements. If we get down towards this best buy support line, which we've almost gotten there, a couple days ago, last week we were within a few pennies of it. I added a few shares, but if we get back down there again, I'm going to buy 10 shares. If we get down below 195, then I'm going to sell another cash secured put. So you guys might remember a few weeks ago I sent out an alert, and I know this is new to many of you, but hopefully some light bulbs are going off in your mind. That we collected $325 for agreeing to buy Royal Gold down here at $170 by August 21st. Well, price bounced, and we were able to buy that contract back for pennies on the dollar. So I just locked in profits, freed up that cash, so that if we come back down here again, I can collect another $300 or so. I mean, we'll see what the premium is at the time, but I would imagine it would be pretty similar, probably another $300-$400. And you can just do this over and over and over again. I mean, if you just did it once on one stock, once every 45 days, that can be $300-$400 every month. And what's your chances are you're not going to get assigned the shares. But if you do, it's a quality company that you want to own anyway. This is what investors like Warren Buffett is a big seller of cash secured goods. That's how he likes to accumulate shares. So it's a strategy that a lot of retail people don't really know about, and it turns people off because of the language that's used, the lingo, premium, and there's a lot of options like lingo that can make it seem more complicated than it actually is. That's my point. Anyone can do that. It's not that hard, and we make it really simple in that options group. All right, let's take a look at silver. I call this the MOAS, mother of all support. This trend line right here, breakout, back test. Let's call it a wide zone, 48 to 54. I mean, that's a pretty wide zone, admittedly. And I'll just say, if we dip below 48, I'll say I've been wrong. I do not think we're going to go below 48. To me, that's kind of the lower range within the spectrum of plausible short-term outcomes. Anything is possible, though, but I really don't think we're going to go to 48. If we get to 54 or 48, that's where I'm going to buy pretty darn aggressively, because I think the risk-reward ratio would be such a setup that you get that kind of setup once every few years, if that happens. Not predicting it. I think that there's a better than 50-50 shot that this $55 low you can see right here on July 17th was the low. That's probably about it. But one more flush lower is totally within the spectrum of possible outcomes. So if-then statements. If this happens, then I will do this. If this happens, then I'll do that. Having those if-then statements is key. Now, I meant to mention this in the opening comments, and I'll talk more about this in the Financial Freedom live stream on Wednesday. But I'm looking over the next few quarters for price to move higher in all of our focus sectors. But I think the big move comes following the next bust, the next big deflationary impulse, as I call it. And I think it'll be the Fed's response to that next crash, quote unquote, that sends hard assets, commodities, and especially silver and gold to these extremely high targets that many of us have had for a long time. So if we run up towards the previous highs in all of our focus sectors, really, silver up near 120, gold near 5,600, uranium north of 100, if that happens before the next big deflationary impulse, or we might call it crash, I don't like to use that dramatic language because it can cause you to make irrational decisions. But if we get a run up to those previous highs before the next big deflationary impulse, I'm going to take aggressive profits. Now, after the next big crash, and I think we're going to eclipse these levels by a wide margin, and I'll be much slower to take profits following the next big deflationary impulse. But I won't have a lot of cash available. So that's kind of my whole operating thesis. But I do have some core positions where if I'm wrong, what if this deflationary impulse doesn't come and we just run up to $200 silver, $200 uranium, $10,000 gold before some kind of big crash? Well, I would miss out because I'll take profits too early, but I have core established positions that I'm willing to hold for the next deflationary impulse, so I'll have a seat at the table if we just keep going higher, even though I don't expect that. Wheaton Precious Metals 101 level. Here's my if-then statements. If we get down to this 101 level again, I'm going to add a few more shares and sell another cash secured put. We've already got an open one. I forget how much, but collected income for agreeing to buy all the way down here at $90. Not a bad deal. Get paid to potentially accumulate shares in the next month or so at an even lower price. Core mining, a little bit riskier than the big royalty and streaming plays, but it's fallen by 50% from its previous high, and this 1355 level is the next area of support. Any dips down towards there, I think, are fantastic buying opportunities. All right, let's take a look at the Sprott Physical Uranium Trust. This one is a high conviction setup, especially over the next couple quarters. Let's call it remainder of 2026. I really expect for this to be trading higher by year end, barring some kind of general stock market, quote unquote, crash or deflationary impulse. I think uranium is going to be, this whole sector is going to be much higher. And to include the nuclear stocks, I've been in the habit of saying uranium. Well, what I mean by that is, even now I'll expand that to include the nuclear sector too, with SMR stocks like Oklo, for example. So here you can see the discount to net asset value. Shoot, I forgot to update this. It's 12.9%. This is not accurate. See right here. It's 12.9% is the discount to net asset value, and 12.9. You can see it better on this graph here. Let me make this big. And this goes back to inception in 2021. And you can see right here. Let me get this out of the way. Anytime you get to this right here, 10% or greater discount to net asset value tends to closely coincide with lows in the sector. You've had some spikes below that. I mean, you've had some down to about 15% here, and another one down to almost 20% in 2022. But besides those two kind of very brief outliers, anywhere near this 12% has been pretty close to the lows. Conversely, I mean, we've had it trade at a premium to its net asset value. Well, that's a time to trim profits, because let's just say, for easy math, the spot price of uranium is $100. Well, at a 10% premium, if you sell shares of SPUT, well, you're effectively selling uranium at 110. Conversely, right now at a 13% discount, let's just say for easy math, spot price were $100, which it's not. It's in the mid-80s. Let's just say for easy math, it was 100. Well, at a 12.9% discount, well, you're getting it at 87.1 or $87.10, even though theoretically price was at 100. You get the gist of what I'm trying to say here. You're effectively buying physical metal at a discount right now through Sprott Physical Uranium Trust. I like that a lot. Probably not like a 5-bagger upside from here, so not as much upside as the mining stocks, but also less downside risk. Most conservative way to play the sector. My favorite way to play the sector is URNM, Sprott Uranium Miners ETF, which holds about 15% of its weighting is in physical metal, largely Sprott Physical Uranium Trust. 4682 is the most recent low to watch as support. We're down by 45% from the January peak. That is a huge sell-off by any metric, and we're back in the accumulation zone from my perspective. UEC, probably the best value proposition in my opinion, and other people may debate that because people have their favorite mining stocks, right? And I get it. I like UEC because it's liquid, it's large, and when the large institutional investors who maybe don't have an expertise in uranium say, hey, I want to get some exposure to uranium, they're going to go and look up what are the largest cap names, what are the best names, and they're of course going to find Cameco. They might find Kazatomprom, but probably turned off by the jurisdictional risk of that one. But then the next one they're going to find is UEC, and below there would be like NextGen and Denison. But UEC is going to be right at the top of that list. It's liquid, they're a producer, and I personally like that they're unhedged and they're debt free. So a lot of these mining stocks tend to hedge their production as a risk, as a risk management tool. And I get it. I'm not even saying that, disagreeing with that, but UEC has kind of got a lot of leverage to the uranium price because they're unhedged, at least as of now. Cameco, I got a small starter position here, right? 83.15 is the most recent low. We got to extreme oversold last week. You can see this RSI bounced just a little bit, and Cameco just reported earnings on Friday. And initially the stock was up, and then it closed down by 2%. So the market wasn't too excited about their earnings. Moving on here, Oklo. Stand out here, Oklo. High risk, high potential reward. Remember, this stock has no profit right now, right? They're not making money, and they're probably not going to for quite a while, maybe 5 years or so. But if their technology works out and gets more mass adoption, then this stock could easily exceed this previous time. It was up to $193, and now it's down in the 30s. So this is a speculative position. I'm keeping position size relatively small, about 125 shares in my core long-term bucket, and I like trading this one, collecting options premium because it's so volatile. You get very fat premiums by selling puts and selling calls on this stock. Constellation Energy, I've got a small starter position. I want to have more, so here's my if-then statements. We dip back down towards 240, then I'm going to buy a couple more shares. I've already got that starter position. If we get down to this recent low here of 228, I'm going to add even more, and I'm going to sell a cash secured put. All right, let's wrap up here with oil. To keep it simple, there's so many cross currents in oil right now, and trading off of headlines is very kind of seductive because it feels like, if this Iran war persists, oil's going to go to 300. It might, or 200, pick your number, and it very well could. But just trading off of headlines is very difficult because the big money, the smartest, the big oil traders, let's say, have access to more information that you and I just don't have, and we're not going to. I mean, they've got the instant real-time like satellite images of ships going in and out of the strait. They've got information on the ground that you and I don't have access to. So there's very smart people that I follow who make a case for lower oil prices if hostilities, cease or even just cool down a little bit. And there's also very smart people who make a case for much higher oil prices. So rather than kind of get into the prediction game, I'm taking more of a neutral stance of I don't know and making my if-then statements. If we get down towards this range, well, I'm a buyer, or I'm selling puts, which is a way to express a bullish position. Or outlook, I should say. If we get up towards 120, well, I'm going to take more of a profit-taking selling calls. Selling calls is the main way I'll express that kind of more cautionary outlook up near 120. Now, if I take profits, like my shares get called away up in this area, yeah, that would stink. And if we keep running towards, say, 150 or 200, yeah, that would stink. But I also would be content because my cost basis is way down here, and I'm selling way up here. And I would miss out on any run by selling call options. But I'm willing to take that risk because I also got to look at the other side of the coin, that it could have just come back down into the 60s. So unless you've got a very high level of conviction or some deep understanding of the oil market, I would just be cautious here. And to me, I'm just selling calls up near the upper end of the range and selling puts near the lower end of the range with many of these stocks. So I sold some call options on Chevron up here, right? I said, hey, if it gets to up here, I think 210 was my strike price. So it's got to go all the way up here in the next month or so. And I collected a few $100 for doing that. Now, if price rises, well, I got to sell the shares up here. But that's okay. That'll still be a really fat profit for me. I only did 100 of my 250 shares. So it's at about 40% of my overall position. So if those shares get called away, I collect the income, sell for a higher price, lock in a profit, and I still have a core position. In ExxonMobil, I haven't sold any calls yet on this pop here, but if strength persists, we get a little bit more, a couple more green candles, I'll probably sell a call option on ExxonMobil as well. And then last chart, just going back to Schwab US dividend ETFs. I know a lot of people who are new, like, what's he owning this for? Like, I thought this was silver, uranium, gold, and platinum. Well, I'm also an income investor, and Schwab dividend ETF holds the top 100 dividend-paying stocks that are profitable stocks. It's an algorithm that searches for stocks with a consistent trend of dividend growth, paying a dividend, but dividend growth as well. So right here at the 5-year growth rate of the dividend, it's been growing at 9%. So the yield is currently 3.38%. I mean, that's kind of an older snapshot, so I think it's a little bit higher now. But it's consistently, that yield has grown, or the dividend, the payout has grown by 9% per year for the last 5 years. That outpaces inflation. And it's not necessarily this yield that grows. Just to be specific, the payout is what's grown. So it pays $1.05 per share. Well, if this persists, well, by next year, it'll pay 10% higher than that, or 9% higher than that. And it's got that consistency of the last 14 years. I never plan to sell this. So I don't really, what's nice about being an income investor with high quality assets is, I don't care about the price so much. In fact, if the price comes down, I would love it because I can still collect that dollar per share of income in the form of dividend, but it costs me less to buy that income. So I have no worry about the share price of this. And if it comes way down, great, because I'm not selling it. I get more income, and those dividends get reinvested. I buy more shares and more cash flow. So anyway, I just want to share that with you. I'm going to go ahead and wrap it up. Hopefully you found this short video helpful. One more weekend of me traveling next weekend, and then I'll be back into a more regular routine. Thank you so much for being here. God bless you. I'll talk to you soon.